you all so much for being on this free webinar tonight. I know you guys could be doing anything on the planet besides listening to me and getting this great free information, but I want to make sure you guys get the right information from the right person. So let's go ahead and get started. Give me a moment here as I go ahead and share my screen really quickly. All right. Perfect. All right. So if you guys can see this okay, just let me know if you guys can see this okay. I'm going to open up another screen here. Give me a moment. I just want to make sure you guys can see this. All right. By the way, the chat is live, so make sure that you guys, if you have any questions, just let me know. You can always just go ahead and sign in. It can be completely anonymous. You can sign in with Facebook. You can also sign in directly with Twitter as well. So, but yeah, all right. So let's go ahead and get started. So first off, the name of the company is Go Simply Pro Credit Consultation. Some of you guys know that already, and we'll go ahead and get this started. This full screen here. All right, so introduction, who am I? My name is Calvin O'Neill Russell Jr. I'm a certified FICO professional. I am also partnered with bankrate.com and realtor.com as well. Okay, so now bankrate.com, some of you guys may know about the site. Bankrate.com, they pretty much have all of the interest rates. Interest rates change daily. We know in the mortgage industry, in the auto industry, credit cards and things of that sort. Of course, if you're always looking for, shopping for credit cards or personal loans, it is a huge site to go with. So I'm partnered with them, which means that I understand about how interest rates work, how interest works, the best credit cards for people, the best personal loans that people should take out. I always like to say that sometimes it's not the loan itself that's the problem. A lot of times it's the right activity, just the wrong bank. Okay. The next one is realtor.com. Some of you guys may be familiar with realtor.com. It's pretty much very similar to, let's say, like a Trulia or give me a moment here. And it's pretty much similar to a Trulia or a Zillow. But of course, realtor.com is a little bit more updated, a little bit more of a cleaner slate on the site itself. And so pretty much what realtor.com does, it helps people find apartments as well as homes. I know a lot of times when you go to Trulia or Zillow, a lot of it is pushed toward, towards mortgages, and which is nothing wrong with that. But if you're looking to get an apartment, I know it's a great route to go there as well too. Okay, I'm gonna go ahead and make this a full screen so you guys can see that a little bit better. I hope you guys can see it a little bit better. Okay, perfect. All right, so by the way, if you guys are watching this, of course you can watch this on any device. If you're watching it directly from the site, and I know one person mentioned earlier they're watching it from the site, and they mentioned that it sounded a little choppy. Of course, this is all based on, everyone's connection is a little bit differently, but I have another screen going, and it's going pretty clear on my end. You can also tap the screen in the center to take it directly to YouTube, and you can actually watch it live directly from YouTube as well in HD. But of course, as long as you guys can hear me okay and keep up with the slides, we should be fine. All right, so now, what is Go Simply Pro? Go Simply Pro is a credit consultation company that educates its clients on credit scores and reports. Okay, our mission is to help our clients achieve their financial and credit goals. All right. Now, I always like to, I'm not from St. Louis, I'm actually from Memphis, Tennessee. But the reason why I brought up, not St. Louis, but Missouri, is because they're also, their nickname is the Show Me State. And I love doing business with a lot of people. But one of my biggest things is credibility. A lot of people say that they're good at certain things, but I want to know exactly who are you helping, and are they really seeing results? So before we get into the big portion of what I'm about to talk about this evening, how to build credit for your children, I want to make sure you guys know that I know exactly what I'm talking about. To the left, you're going to see one of my clients' success stories. As you can see there, in March, she was a 597. By September, she was a 752. Now, granted, everyone's situation is not going to start off like that. I'm sorry, it's going to end like that. Everyone's credit report is different, okay? And I do apologize for the watermarks on the photos because I actually, when I first started posting on Instagram, I saw one of my photos on someone else's page. I don't know if their page was hacked or whatever, but I said, okay, I got to start watermarking my stuff. People are taking my results. So the one to the right is another client success story. As you can see, he started off as a 609 in October, and by November, his score was a 722. Okay, so not bad for 1 month. Again, results may vary. All right. Then this is another client success story. By the way, these are all three different clients. As you guys can see, these are all three different platforms. So whatever platform someone uses, whether it's FICO, whether it's Credit Karma, whether it's Privacy Guard. It's so much stuff that's out there. 90% of lenders use FICO, but we don't have to go into that. If you guys can easily download my free ebook, Everything You Need to Know About Your Credit Score. So that's for free on my website. It's all around my site. You can't miss it. So and you really can't see the starting point because we just had started his Credit Karma account, but you can do the math. You see right where it says Equifax, you see it says 135 points. So we don't have to be math whizzes to see that his score was about a 490 something. I think it's a 498 or 494. And either way, so this is the results you guys are seeing are actually within 30 days. Okay. And then approximately 7 days later, all right, which puts us at somewhere between 30. Well, I believe it's somewhere between 30 to 45 days, to the left. But I know on the 45th day or the 46th day, on the right-hand side, you'll see where the Equifax jumped again, and it put him at 676. Of course, this all happened, all of this within 45 days. So he went from a 494 to a 676 in 45 days. So I want to make sure I showed you guys this just to show you guys, not bragging or boasting, but just to show you that I know exactly what I'm talking about, as this is credit and this is financial information. So I want to make sure you guys know the right information from the right person. All right. So now, why this topic? Simple. Young adults are faced with financial decisions on a daily basis. Most of those decisions require having a good credit history. Like most financial education, most of it is learned from the parents. Okay, and you guys know just as well as I know that information can be good or bad. I even know some parents that have phenomenal credit, but just so you guys know, credit scores came out, well, they got really popular around the mid to early 80s. Okay, so we're talking 1983, 1984. So credit scores haven't been out for a very long time. They used to do an interview process, but either way. And now, right now, 90% of lenders use FICO, the FICO score, FICO. That stands for Fair Isaac Incorporation. That's who also gave me my FICO certification as well, to even have the knowledge to even do this webinar. All right. So actually on the FICO 9 as I'm speaking. That means that the FICO scoring algorithm, of course, the algorithm looks at whatever is on your report and then generates a credit score. Okay, that algorithm has changed 9 times since 1983. Okay, so I say that to say a lot of times as parents, they mean no harm, but a lot of times they give, information based, but it's old information. Okay, so that means that what a person would give credit, let's say back for credit advice, from 2005, the last time they were probably educated on credit or something like that, and they're giving it they're giving the same education now in 2016. That information is gotten old, it's gotten outdated. Okay, so I'm going to show you guys the new and improved ways of how to build credit for your children. All right. Now, what are some ways to build? Of course, you guys know I got to go with this one. This is the easiest way to build your credit, and this is actually way number one. All right. So now, and the easiest way is to add them as authorized users on your credit card. Now, let's break a few things down. A lot of people are not familiar, I won't say familiar. A lot of people are not comfortable with credit cards and things of that sort. And I say so I say that they're not really comfortable with them, mainly because they're not educated properly on how to use them. Okay, so and that's where you want to make sure that if you're giving information out to people, that they have the right information. Okay, so you want to add them as an authorized user on your credit card. Now, I believe I have on here. I don't think I have it on here. Okay, there we go. Sorry about that. All right, so we'll talk about that. Okay, perfect. All right, so now, what is an authorized user? Okay, number one, an authorized user is someone that you add that the primary account holder is they can add to uh, the account, and they receive the same account reported the reported account history. Okay, so that includes payment history, utilization history, how long the account has been open, and things of that sort. So there are pros and cons, as I'll get to in a moment. So now, as you can see in the paragraph, most credit card companies will let you add up to 5 authorized users to your account at no additional charge. Okay. Keyword, I said most credit card companies. You do have some companies, the big dogs like American Express and others that will charge you. And there are some small company credit card companies too that will charge you to add authorized users. So I would check with your bank to make sure to see if you have to pay to add your child as an authorized user. Okay. And that is one way. Oh, someone just asked a question on Facebook. So, what is the age? What is the earliest, the youngest age, rather? I get what you're saying. So, yeah, what is the youngest age that you can add an authorized user to your account? Actually, there was one bank that used to let you do it as early as 15. Okay, but most banks, I don't know, I don't think they do that anymore. They just changed their credit card agreements about last year. So, but the earliest that you can do it is 18. Now, you're probably saying to yourself, well, Cal, this is when the kids start wanting things. They start wanting cars. They start wanting, different types of things. So, is there any way early that you can do it a little bit earlier? There are some ways, and I'll get to that a little bit later, but the easiest way is to add them as an authorized user on your credit card. Okay. Now, as you can see in the paragraph, authorized users receive the same account history as their primary account holder. As I mentioned earlier, this includes payment history, utilization history, and account lift history. Okay. Authorized users can only be added or removed by the primary account holder, the primary account holder of the account. All right. So what does that mean? That means that number one, you're adding them as an authorized user simply because, let's say, for example, you as a parent, you have a credit card, you pay the bill on time, you keep the balance low, and you've had the account open for quite some time. So all you have to do is add your child to that account, and most credit card companies will ask you, do you want to send excuse me, do you want us to send out an additional credit card, to this account? A lot of times it can be optional. Even if you're forced to do it, you don't necessarily have to give them the credit card. Because keep in mind that if you do give them the credit card, they can swipe that credit card. Now, granted, they do have limited access, but they can swipe the credit card. Okay. Some parents let their children have it for, emergencies. But some parents, they're not fond of it and they don't want to let them do that. So, me personally, I mean, I don't want to take the risk. So because like for example, if there's an emergency, you can always transfer money at any time of the day if you guys have your accounts linked up. So it doesn't necessarily have to be a credit card because we would hate for that to get into the wrong hands. But either way, this is one of the easiest ways to do it because it costs you nothing for most banks, and you can actually do it online. You don't have to be on hold with anyone or anything like that at all. As a reminder, if you guys have any questions, you can also you can type them live on the website. That's GoSimplyPro/webinar. And at the bottom, under where you see the webinar screen, you can actually ask any questions there. There are some people that are that are sending me messages on Facebook. That's not a problem. But the chat probably is a little bit easier because it comes through instantly if you have any questions. All right. So authorized users continued. All right. If it's so simple to add your child as authorized users, why don't most parents do it? All right. The answer is simple. Most parents don't know that they can do it. All right. And then also, now here are some pros and cons about being an authorized user on a credit card. All right. Pros. Of course, on-time payments show up on the credit report. And as we all know, 35%, which is the largest percentage of what makes your credit score, actually comes from payment history. So if all of those payments are now shown on your report as well as the authorized users report, essentially that's going to help them improve their credit score. All right. The con of that is that the late payments will also show. Now, credit reports are only interested and because everyone has their own definition of being late. Technically, if something is due on the first and you pay it on the second or the third, technically it's late. But credit reports are only interested in payments that are 30 days late or more. All right. Again, 30 days late or more. All right. Another pro, low utilization percentage. Now, utilization, let's talk about that for a moment. A lot of people don't talk about utilization. They always talk about payment history. And once again, that's the largest percentage, 35% does come from payment history. The second highest percentage of what makes your credit score comes from utilization. Now, utilization is calculated by the balance divided by the limit. Okay. Again, utilization is divided by the limit. So now if a good utilization, I tell all of my clients, I always follow what they call FICO high score achievers. Okay. These are people that have credit scores of 780 or higher. All right. And people that have credit scores of 780 or higher, they tend to have a utilization on average of 0%, which means not even using their card, or there's no balances that show. Or if they are carrying a balance, talking 7% or lower. Okay. And FICO actually just redid a study, and that number has now dropped down to 6%. All right. So now what does that mean? I'll give you guys easy numbers. So let's say, for example, you have, let's say, a credit card. All right. And let's say the credit card has a $100 limit. All right. And if a person is, if they have a $6 balance, then that would be 6%. Okay. And of course, if you have $1,000, that's just an added zero. Then, of course, you just add a zero to the number 6. Now you're talking about 60. Now, granted, here's another myth, though, is a lot of people think that they have to carry a balance in order to build their credit. This is an old myth. Okay. Well, I'm sorry. It could have been an old rule back in the day, but everything I'm giving you guys is from the FICO 9, of course, and some of this is from the FICO 8 as well. But for the most part, it's the most accurate, updated information directly from the score that is used the most, and that's from FICO. Okay, so and but either way, you want to keep your balances low. All right, if you have to do it. Now, what I always tell a lot of my clients, you don't necessarily have to find things to swipe. I know some people say, oh, well, swipe gas or go to the grocery store and buy some groceries. There's nothing wrong with that. But an easier way is to find, and right now, this is a perfect time because a lot of people have what we call subscription services. Okay. So for example, if you have a subscription service that's like, $10 a month or $15 a month, instead of it being taken out of your debit card account, all you have to do is just simply put it on your credit card and then put your credit card on automatic payments. Now, why would you put it on automatic payments? Well, because it's only 10 to $15 or whatever. And here's the deal. Now you don't have to worry about, number one, the bill getting paid on time because you always have the money in your account as it's $10, $15, whatever, right? And then, of course, secondly, you don't have to worry about utilization because now you're taking, remember, utilization is the balance divided by the limit. So now you're taking that balance, let's say $10, let's say for Apple Music, let's say it's $10. And now you divide that, against, let's say 1,000, we don't even have to do the math on that, so you already know that that's 1%. Okay. So that's a phenomenal, utilization to be on. All right. So now, of course, the cons, actually, there's a typo where it says low utilization percentage. It's actually high utilization percentage. So that's if someone's using the card too much. I'll give you guys a perfect example. One of my clients was on as an authorized user on a credit card. The credit card had a $10,000 limit. Yes, you heard that correctly. $10,000 limit. Okay. Here's the problem. The balance on the card was around $8,400. Okay, so this was actually hurting her score more than it was helping her score. Okay, we're not even going to talk about the interest on that type of card. All right, but because that utilization, remember, balance divided by the limit. So let's just say keep the balance easy. Let's just say 8,000. All right, and the limit was 10,000. So you do the math. That's 80%. Any utilization, write this down. Any utilization above 30% will decrease your credit score. I don't care what anyone says. All right. For the record, I see 20 to 30 credit reports on a daily basis. Okay. So I know a lot of information is out there, but I see it on a daily basis. All right. And any utilization every single time above 30% will decrease your credit score. So again, now how can you do the math on that? Simple. Take the balance and divide it by the limit. All right. So and then you'll be able to see, what percentage that is. All right. So of course, another pro is you'll be able to build a relationship with the bank. The con is you can ruin a relationship with the bank depending on how that person is using the card. Pro is a second credit card is optional, so you don't necessarily have to get them a second credit card, which if you do, that may become a con because then the kid may go swipe crazy. Who knows? So then, of course, the second way is to add them. Number one, it's free to add them in most cases, and you can add them online in usually 2 minutes or less. Okay. Another con would be procrastinate adding the young adult because it is free and because you can do it online. Most parents know about adding authorized users. They just never get around to it or they forget or whatever. And by the time that they even think about it, now they're being asked to co-sign. All right. So be prepared to be asked to co-sign if you're not educating your children on credit. This is just as important as a savings account, a checking account, we're not into my balancing, your assets and liabilities, all that type of stuff. We're not talking about doing a balance sheet. We're talking about just this is basic stuff, So because if they're going to want to get an apartment or if they're going to want to get finance a vehicle, you can always pay cash. But one thing, because a lot of financial gurus, they'll say, oh, you don't need credit. Yeah, no problem. We'll try to get an apartment without one. We're talking about something basic. We're not talking about adding on debt. We're talking about just getting an apartment, right? So there's a lot of things. So either way, let's go to the next one. Now, the second way is to add them as a joint applicant on installment loans that you can qualify for on your own. Again, add them as a joint applicant on an installment loan that you can qualify on your own. Now, let me back up a little bit. Oh, sorry. The screen is going at the same time. I thought it was something looked a little weird. Either way, so the thing about doing this is that I want to make sure that there's no confusion. You don't want to get a loan that's not needed. If you want to, that's up to you. It's nothing wrong with doing it like that, but I don't want you to take out, I don't tell my clients to take out a personal loan just to put their kids on it, just so their kids can build credit. Okay. Does that work? Absolutely. But why would you, now you're pretty much getting debt for no reason just to help them build their score. It's not like the credit card. If you're using it properly, you're using it anyway. But it's not like the credit card where it's already there. You're not buying unnecessary items. Okay, so you'll see where this is going. This way is not as popular as adding them as an authorized user, mainly because this requires a fair credit score, which I would consider 600 or higher, and the higher the better, of course. Okay, but here's why. If a parent adds their young adult, okay, 18 years or older to an installment loan, that could be an auto loan, a personal loan, or etc., the interest rate will be based on the primary applicant, which would be the parent, okay, as well as the joint applicant. Okay, this is where a parent's credit score plays a role. I'll give you an example. Let's say if a parent has, let's say, a 550 credit score themselves, and they get, let's say, a personal loan, that interest rate is going to be high. If they add on, essentially someone that has no credit history, that interest rate is a bit more than likely going to get higher. And of course, the same thing with, if you get a personal loan, even if your credit is phenomenal, you have to understand that they're going to take an average, or they're going to take a look at both of the credit scores. And some banks do an average, some banks do their own type of algorithm. They just look at it and say, okay, this is what a rate is going to be. But there is credit that's going to play a role in that. Okay, so The joint applicant continued. By the way, some of these I haven't really explained the pictures on the right. Some these are real success stories too. These are more of my clients that are just, hey, they're happy clients with Go Simply Pro. What can you say? So the girl, the young lady to the right, actually, she actually improved her score tremendously in less than 2 months, I believe, and less than a month actually, and was able to get a brand new vehicle. So how awesome is that? So congratulations to her. And I know she went through a short journey. And I mean, it can happen, guys. It can happen. So either way, the reason why the parent's credit score plays a bigger role in this case, as I mentioned, is because of the average credit score between the primary and the joint applicant. All right. The interest rate will be high and only get higher if the joint applicant, assuming that the joint applicant has no credit at all, is added to the account. This option has its cons, but the reward is well worth it. All right. And I'm going to tell you guys a quick story here. It's called The 24-Year-Old with a 746 credit score. And I put at the bottom, thanks, Mom. All right. So just a quick story how this worked out. There was a young lady. She was about 40 and she had a daughter. She was, I believe she was 18. Okay. I think she was 18 or 17 or something like that. And the mom, the daughter wanted to get a car. Now, normally in a situation like this, what some parents do, which is backwards, they will, the parent will continue to drive, their car, which depending on what type of car it is, I can understand. But if it's like an older car that you're driving, it only makes sense to give the older car to the teenager if you're going to give them a car. Okay. But what I've seen some parents do, they'll keep driving their car and they'll just co-sign for their their young adult as their child, the 18-year-old, 20-year-old, whatever, and they'll co-sign for them to get a car, right? And then of course, they qualify, they get the car, they drive off, everybody's happy. But I'm gonna show you guys another scenario. This is a real life story too. So the 40-year-old lady, what she did was she gave the older car to her daughter. And so now the daughter's driving the car. All right. Now it's an older car, but not so much older, but it lasted for a good period of time. The mom says, hey, I'm the one working. The daughter's the one going to college. Perfect. This works out perfectly. I'm going to go get me a brand new car. She goes to the dealership. Mom has great credit. By the way, you don't necessarily have to have great credit, but you can do this if you're about a 600 or higher. I recommend you do. The mom just so happened to have about a 720 credit score. It was a nice credit score. And so she qualified for the auto loan by herself. All right. Normally in a situation like this, mom just puts everything in her name and gets the car, right? This is where it gets fun. The guy that was that she was in the finance office with, he says, why don't you add your daughter onto the auto loan? She says, well, this is my car. The car's not for her. I want this to be 100% in my name. He says, I understand that. But if you add your daughter to the auto loan, your daughter's going to develop what she's going to establish auto credit. Now, it's the same thing as any other credit, okay? But with FICO has 9 different scores with each report. That's a whole nother webinar, okay? And one of those scores is your auto score. That's why sometimes when you go to the dealership and they run your credit, that's not the same exact score you just saw on Credit Karma or even my FICO. It's on my FICO though. It's you'll see it where it says auto score, and they normally go by the auto score 4. And that's from the old FICO 4. So just little things like that, it's good to know. So the lady says, okay, no problem, I'll go ahead and do that. Sure enough, she adds her daughter onto the auto loan. The interest rate does go up a little bit. So I think she went from 5% to 7% or something. So her monthly payment went up by $8. Okay, no big deal, right? So 6 years go by, okay? So now the daughter went from 18 to 24, all right? Now remember, the daughter had no credit at all. She wasn't even trying to build credit or anything like that at all, right? But guess what? 6 years later, now that car that mom gave her is starting to die out, she wants a car. Normally, what do parents do? They go to the dealership together. They say, what kind of car you want? Great, I'll co-sign for you. Nope, because this 24-year-old had a 746 credit score. All right. So now these are things that you're already doing as parents on a daily basis. Okay. You're already getting cars. You're already getting credit cards. You're already getting personal loans, whatever you're doing. Of course, you can't put them. Well, you can put them on a mortgage, but that's just the paperwork today with mortgages is ridiculous. But either way, but these are things that you're doing already as a parent. All right. So it's not costing you anything additional. Well, in this case, if you're adding them on as an auto loan, then of course you're talking about maybe a small spike in interest, but that may not necessarily be the case. Sometimes you can still get a special interest rate. But either way, let's just say that your interest rate, if you added your child on, you had to pay an extra $10, $15, let's say $20 a month, right? Because you added them on. First off, I would sign any parent up today to pay $20 a month to technically establish the credit for their young adult. All right. That way, when it's time for them to get a card, they don't have to co-sign for them. Do you have to wait 6 years for this? Okay, someone just asked a question on Facebook. Does it have to be 6 years? It does not have. I'm glad that's a good question. It does not have to be 6 years. Now, granted, the mom just happened to take out a 6-year loan, but honestly, the credit can be established in 2 years, in 18 months. So it really all depends on what type of bank. But I've seen people, as time and time again, where and this is what if I was to call it anything, I would call it a name. Reverse co-signing is what I would call it. So if you guys hear anyone say reverse co-signing, you heard it here first. All right. So that's that story. All right. So a parent's role in student loans. Yes, you play a role, not because you told us to get them, but mainly because you told us to get them. No, I'm kidding. So, but here's why. Normally, when it's time to start paying back the student loans, the parents start getting the letters in the mail, not because they're on the loan, not that it's in their name, but sometimes a lot of kids go back, they move back home, to kind of get on their feet, after they just graduated, whatever. But either way, the parents play a role in this too. Not just because you, of course, told them to go to school, but I'll go and read the paragraph. So most parents in this generation are encouraging their young adults to further their education by going to college. Again, nothing wrong with that. This normally requires the help of financial aid through student loans. Getting the student loan is not the problem. Paying back the loan normally is. Of course, the young adult has the student loan, should prepare themselves to pay it back, but at the same time, they should understand the consequences of late payments and such. It all starts from home. Okay, so for example, it's not a parent's job to necessarily remind their child about paying their student loans, but more so educating them on why they would pay the student loans on time. Okay, so it's just little things that I would recommend and that I would talk about for sure. Okay, so but either way, let's see here. So either way, I recommend doing things a certain way. Okay, and you want to make sure that people are able to understand and grasp, especially as you have no children. You want to make sure that people understand that if you're late on the payment, it's going to affect your credit score. If you're late on, let's say, if you're late on, like for example, a big thing that I always see that people always have when people their student loans in deferment. And if you don't do that, or pretty much when it's time to pay and they ignore the phone calls, then if you do that, keep in mind, if you do that, then of course they're going to report all of those late payments on your credit report. Okay, so now you're getting, remember, 35% of your credit score comes from payment history. So now you have all those late payments, showing up on your credit report. That's not only is it hurting the score, but it's making things a lot difficult, to actually build your credit score. Make sure I brought that up. All right, so now let's see here. If you have any questions, feel free to type it into into the chat, so you can also ask them via the Facebook page. I'm getting some through Facebook. I'm getting and you can also use the chat down at the bottom. Okay, and it's completely anonymous. You can put a fake name if you want, whatever you want to do. That's completely fine. All right. But remember, a parent's job, a parent's role in these student loans, you must let them know that you cannot let these student loans go into default. They don't even necessarily have to be on a payment plan, but they must be into a deferment, some type of payment plan. Okay. And there are some of these student loan collectors that are actually taking as little as $5 a month. Okay. So now, granted, you don't necessarily have to pay the $5 a month, but I would recommend, at least have, doing something for sure. Okay, so just something to think about. All right, so let's see here. Let's see what else we got. Student loans continued. Oh, okay. All right, so now let's talk about this really quickly. Refund checks. All right, now this is my own philosophy because it just makes sense. Parents should encourage their young adults to give the money back to the loan company. Okay, the student loan company. Most installment loans never offer refund checks. All right. And the only way to make it, pretty much, it only makes the debt amount larger. Think about it. When you go get an auto loan, and let's say the car costs, let's say out the door you're at $10,000. Okay, pretty good car, right? So let's say out the door you're at $10,000, and the bank doesn't give you a loan for 13,000, 10,000 to pay the dealership for the car and the bank, so they finance you, and then 3,000, hey, just to keep, just in case. They don't do that. Okay, when you're buying a mortgage and you're buying, let's say, a house, let's say for $100,000, the bank doesn't give you a loan. Now there are special types of loans that you can use to update the home and things of that sort, but you guys know what I mean. If you're buying a house for, let's say, 100,000, the bank is not giving you a loan for 105,000, 100,000 to pay for the home and 5,000 to put in your pocket. That's stupid. So why do we take these? I am a victim of it myself, where we took the refund checks and then we just blew the money, right? Let's just do a couple math. Let's just do a little math on blown money. All right. So the average refund check, average, and I thought this number was kind of low. The average student loan refund check is $2,000. So $2,000. Now, let's say if they graduate on time and they get that back each year for 4 years. Okay, each semester. So in a year, that's 2 semesters. So now you got 4 years. That's 8 years. 8 times 2 is $16,000 in refund checks. Who do you know? All right. Now, who do you know that is, hold on, sorry, a notification came through. Now, who do you guys know that would love to have $16,000 less on their student loans? Anybody, everybody, right? Absolutely. So it only makes sense to give the refund checks back. To me, it does. Okay, to me, it does. All right. So now, student loan repayments. Okay, parents should also assist in making sure the loans are either, and I just mentioned this before a few seconds ago. I don't know if I typed it or not. In a deferment or some type of payment plan, the plan isn't to answer the phone calls. I'm sorry, the plan isn't not to answer the phone calls from the student loan collectors, as they will report late payments and decrease a credit score and damage the credit report as well. So you have to do more than just not answer the phone when they call. You got to do more than just not respond to their letters in the mail. They're going to get their money. If you haven't heard me say this before, then you're going to hear me say it again. You either pay them or die. That is it. So either way, by the way, there are ways to get either way. Well, I just want to show you guys something to the right. By the way, my company, we do remove certain items, not all. It's not like not any magic pixie dust I put over your report and things just fall off. Okay, that's not the case. I do help in getting the credit reports up to date and accurate. Okay, so I always look for inaccurate information. Now, of course, if it is accurate, then of course there are other ways as well too. A lot, but see, that's why my company is not just credit repair; it's credit consultation, because things are not just getting things removed. I know a lot of people that spend a lot of time on getting items removed by themselves or for their clients, and you're going to be upset once you start getting a lot of stuff removed and you don't see this huge jump in your credit score. I'm not saying that you should not pay your bills or your collections. That's not what I'm saying. What I am saying is that don't expect some big, huge leap, because as collections get older, they have a lower weight value. So, for example, they matter less to a credit report as they get older. Once again, it doesn't mean that you shouldn't have to pay them. That's another webinar for another day, though. So, okay. So let's move forward. The bottom line, now as a parent, you can see that there are multiple ways to help your young adults build a high and strong credit score. I've seen all these ways work in the best favor possible, for the parent and the young adult. There have been many cases in which I've seen scores as high as 760. Okay, and the young adult had no idea about their credit score being so high, or most importantly, how it got there in the first place. Again, another client testimonial to the right. As you guys can see, this is actually to the left. It's actually not even when we got started. Once we got started, it was a little bit lower than that. But you guys can see there, not even a full 3 months, you can see how the score is starting to improve. Just because how I do things is a little bit different. Everything I do is simple, and of course, it's professional. So you got to go Simply Pro. All right. All right. So now, the next step as a parent, you got to lead by example, right? You don't have to be great to start. but you must start in order to become great. No matter what your credit score is right now, there is room for improvement. All right. Children have report cards and adults have credit reports. The question is, are you leading by example? All right. Or is it time to lay the foundation for your family? All right. Because I meet a lot of people, and some people say, well, Calvin, you know what? I have great credit, but at the same time, I want to know exactly, how can I build, credit for my children? And that's a great question, guys, because you want to make sure it's not just about you. All right. So yeah. So someone says great webinar. Thank you. Phone test. That's weird. All right. So but yes, no. And guys, first I want to thank you guys again for even being on this this webinar. So as we wrap up now, what is the cost to become a Simply Professional client? All right. Now I do want to break this down. Lexington Law, of course, they charge $89 a month. And let's just say in 6 months, what would you end up paying? And you actually end up paying $534. So with creditrepair.com, it's $69 and you end up paying $414. Now, and by the way, both of those companies, you keep paying them. Everything is monthly. But question, why would you keep paying them if your score is 700? But there is no stopping. Okay, so I love how I got that photo where it's like sweeping up the money. Let's save you some money here, okay? And with Go Simply Pro, it's only $300 one time, or it's $130. This is a payment plan one time, and it's going to be $39 a month for 5 months, and that comes out to $325. That's pretty affordable, right? And you know when everything's going to be done in 6 months. Okay, there's no need for us to go longer than that. My clients average 25 to 30 points a month. Okay, and that's just on average. Now everyone's situation is different. Just like if you have, let's say a personal trainer, and and they tell you what to do, and you don't do it, then you can't expect to have results. And what I noticed about a lot of adults is that it's hard for us to take responsibility, and you must take responsibility. Okay, but I do have something special for you all, and that's our webinar special, and that ends tomorrow at 11 p.m. Instead of paying $300, it's only $249 upfront, or the payment plan has been reduced as well, or it's $89 one-time startup fee and $39 a month for 5 months. That's only $284. Now, who else is giving the results that you're seeing right here today, giving free information? On my website, you can get a free ebook, all this free information, and I'm still helping people improve their score 5 to 30 points a month. Okay, it's almost seeming unreal, right? But at the same time, I know for a fact that I can help you regardless of where your score is and get you to where you need to be, so you can show your children where they should be as well. All right. So at this point, I do want to take any questions, comments, or concerns. I know I've been getting a few questions. Some people actually been emailing me as well too. So I hope that I answered some of your questions. I know some of them I did not stop in the middle of the webinar, only because I was actually answering the question as I was talking. So I know some of you guys may have some questions. I know someone said in the chat, great webinar, perfect. I appreciate you for being on the webinar. I know it's a little lengthy, but I want to make sure you got everything you came to get. Another question someone may have is this webinar going to be available later on? I'll see what I can do. You can't have stuff lingering out there all the time, not in a bad way, but I want to make sure that people, it's got to be, it has to be, a shortage of something, so you got to be able to act on it. Was it a sense of urgency and a fear of loss? So I got to make sure you guys, get this information directly from me. Hopefully this was helpful. Okay, so let me know if this was even helpful. If you guys like webinars like this, I got way more stuff lined up. It's going to be super awesome, and I'm going to go ahead and start promoting the next one probably tomorrow. So but get ready for that. And I thank you guys so much for being on this webinar. Unless there's any questions, comments, or concerns, I'm checking Facebook. I'm checking Twitter. Everything seems to be pretty good. I'm checking my Gmail. Okay, that's good. Perfect. The chat is live, so going once. Going, and that will wrap everything up. So thank you all so much for being on this webinar. I most definitely appreciate it. Make sure you guys join my free email list. You can actually join right on my website, you know, at gosimplypro.com. You can, you know, like us on Facebook, all that stuff. And but of course, do not forget the webinar special. All right, so you most definitely want to take advantage of the webinar special. And for those of you that attended, I'll make sure I send you guys an email as well on the promo code. That is a great part of being a registered person. You know, so but either way, thank you guys so much. Have a great night. Take care, and I'll see you guys at the next webinar. Have a good night.